Good morning, students. This is our economics teacher, Umar Farooq, from Delhi Public School of Srinagar. As you all are well aware that we are doing a series of lectures on national income and related aggregates. So, this lecture will be the fourth in a row, which will deal with aggregates related to national income, in which I'll show you a few things with which you'll be able to learn the things very easily and incorporate those very things in your class or in your subject, and you'll be able to calculate the numericals, perform the numericals so very finely. So here we begin with this very chapter, where we will be telling you how you can use different things for doing national income and calculate the national income really very properly. So as you are all well aware that you need to have certain tools which will help you to understand the things. The tools in aggregates, national income and related aggregates are basically 8. But how we will reach to those 8 aggregates, we are going to understand the term with which we had started national income once again, so that we may move ahead. Because sometimes there is a confusion in between what is a product and what is the income. So we can differentiate the two. So before we go with this national income and related aggregates, we will come upon the term again. So national income, I am repeating it, is the sum of money, value of net flow of all final goods and services produced by normal residents of a country within and outside. So these are very two important words which we will have to understand. Outside the country. So normal residents of a country, we have explained it during the year. Look at the definition. The definition in itself is saying all of the things. So we are talking about the national income, which is the money value of net flow of all final goods and services produced by normal residents within or outside the country. So these terms have already been explained. Now you must note one thing, that when we talk about the two words, that is income and product, how we can differentiate between the two, the income and the product, how we can say national income and national product, why we use national income and national product. National income at the level of production, national income at the level of production, national income at the level of production of goods and services is called national product. So national income at the level of production of goods and services is called national product, while as at the level, national income at the level of distribution of income is called as national income. National income. So this was the thing which you need to keep in mind before we proceed with what we are going to do. So national income and related aggregates, we are doing the aggregates related to national income today. So as I said earlier, that in totality we have got 8 aggregates. Those 8 aggregates are like, I'll enlist them one by one. GDP, NDP, GNP, and NNP. Basically, we have 4 aggregates. These 4 aggregates are taken at 2 levels, either at market price or at factor cost. So if we rewrite all these very aggregates now, where we would reach at a level where we will be able to name them as GDP at MP, NDP at MP, GNP at MP, and NNP at MP. The second category would be again GDP but at FC, NDP at FC, GNP at FC, and NNP at FC. So in order to define all these very things, you will have to understand the definition of only one. Rest you can incorporate. Before we do that, how we reach from one aggregate to the other aggregate, I'll first explain to you people that G stands for gross, D stands for domestic, P stands for product, which is everywhere, and N stands for net, and the N which comes in between the 3 letters, again the N is for national. So if I take only one example from all these very aggregates, let me take, in order to make you people understand properly, this NNP. See, at first this N, second is again N, P is the product. It's for all. P is here, 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 here. Everywhere you will find it. But this N, if it comes first, this will be associated with net. The second N stands for national. If I change the color, this stands for national. So this N stands for national. So we will expand it. It is net national product. I'll expand it again. It is net national product. See, it is here also, net national product. So G stands for gross, N stands for net, G stands for gross, N stands for net. It's common. D stands for domestic, D stands for domestic, N stands for national, N stands for national, and P is everywhere alike, that is product. So that is how we reach from 4 to 8. But there are many things associated with it. When we talk of those very things, we will be able to understand it, that how we can say this is net, this is gross, and etc. I have made a very small formula for all of these very things. That formula or that table will help you to understand everything really very properly. So let me take all these very words again. First word we have gross. Second word, we have national. Third word, we have either at market price or at factor cost. So I'll take market price. Market price. Associated with these very three words, we have with gross, we have net. With national, we have domestic. And with market price, we have factor cost. Now look at this. On the right hand of your screen, I have written the smaller ones. And on the left side of your screen, I have written the bigger ones. But there is a difference in between the two. You can reach from net to gross, or you can go from national to domestic, or you can come back or go forward. For that, you need to understand, you need to know three more words. The first word is the difference between gross and net, that is depreciation. And the difference between national and domestic, it's national here, national and domestic is NFIA, which stands for net factor income from abroad. What is net factor income from abroad? I'll tell you later on. I'll explain it. And third one is market price. The difference between the two is NIT, that is net indirect tax. What is net indirect tax? I'll come upon it again. But first, let us understand this small chart which I have built for you people, so that you may understand. I'll divide it like in a table form. Will be better for you. Say, I have made a table. This table will tell me where from I can go. Either I can go from, I'll choose some different color now. Okay, I can go from gross to net, or I can go from gross to net, national to domestic, market to factor. Or I can come back from factor to market, or domestic to national, or net to gross. So this is the difference in between the two. If I am going from gross to net, I will have to subtract depreciation from gross. So I will have to subtract here. I'll have to make the negative. So gross minus depreciation is net. Likewise, national minus NFIA is domestic. Likewise, market price minus net indirect tax is factor cost. Or now what we can do? We can come back again. From factor cost to market price, or domestic to national, or net to gross. So we will have to add something. I'll make a positive sign here in order to make you people understand. I'll put it in a circle so that it may be total visible to you, and here also I'll put it in. So that means whatsoever we are doing will be followed by this small formula which I created for you people. This formula is going to help you in many things. Whatsoever you are doing now, you are performing now, will be dealt with by the help of this very small formula. So please bear it in mind that this is what you are going to use throughout. So as I'll be calculating national income, you must keep these very things really very properly in your mind. So let us come upon to one more thing, that is, we will start to define these all very things one by one. So in order to understand the definition of anything among all these very 8 aggregates, we will have to understand only one definition. So we will be able to complete whole this very series. Let us do the definition, then I'll come upon certain formulas, and so that we may reach to a conclusion. So how to begin with it? We may begin with it by defining gross domestic product. Only gross domestic product first, because if we are able to understand one, we'll be able to understand every other aggregate as well. So let me take up what gross domestic product. So I'm starting with gross domestic product. Gross domestic product, or GDP. It is basically the market value of, let me write it down for you people. It is the market value of all final goods and services produced by all producing units located in the domestic territory of a country during a period of 1 year. Now see, look at the definition. It is the market value. The first and foremost thing what we are talking about is the market value of all final goods and services. I am not emphasizing on these very terms time and again, because I have already explained these terms. Each and every word has been explained. So you now may be able to understand or collaborate, hold the definition together. So it is the market value of all final goods and services produced by producing units which are located in domestic territory of a country during a period of 1 year, because national income is calculated, national income is drawn for a year, so we are talking about a year. So time period is important here. So if you will have to explain anything, any other aggregate, whether it is net domestic product, gross domestic product, net national product, whether at a market price or at factor cost, now you people will be able to make all the 8 definitions from this very definition. So you will have to incorporate, or you will have to put small words in between these very definitions in order to understand the other definitions. So if I am taking one more definition, like if I talk of NDP, okay, so let me write down it here, NDP. So let us say NDP at factor cost. I'll define this so that you may understand it properly. Now how can I define it? It is the value of contribution of all the production units. See the association of the words located, again I am writing the same, within the economic territory of a country so in order to reach to the NDP at factor cost, we will have to diminish it by consumption. Okay, I'll write it in a small manner for you people. Diminish it by depreciation, which is also called as consumption of fixed capital, and indirect taxes, and increased, that is added by, subsidies. Now here you must be thinking that we have got a few new words, that is subsidies and all, but first we will understand the definition in itself. So in between these two very definitions, you can now clearly see that by adding or subtracting a few words only, we can make all the 8 definitions in any way, whether or at market price or the factor cost. So let us come upon a few formulas by the virtue of which you will be able to understand the concept of all these very things together. First, let us talk of the depreciation. So I'll take the 3 words which were in between the all things here, as you can see. I'll first talk of depreciation, then I'll say what is NFI, then we will come upon the NIT. These are very small, simple terms. You will be able to understand these very terms very properly. So I'll come upon the first term, that is depreciation or consumption of fixed capital. So these are two names, depreciation or consumption of fixed capital. This is the difference in between the gross and the net. So it is used to differentiate in between gross and net. The simple thing which we can perform here to understand it is, say we have net product, we'll make it equal to gross product. So net will only become equal to gross only when gross is depreciated, gross is subtracted by depreciation. See how simple it is. So likewise, if we have a term say net value added, you will come to know what is value added or value of output later on. So it will be equal to gross value added minus depreciation. So if we have, say, one more term, net investment, so it will be equal to gross investment minus depreciation. See how very how easy and beautiful it is. So now after understanding depreciation, we will do one more thing. We will, later on I'll show you a numerical or the formula also on depreciation, but first we will understand the basic terms. So the second term for us people here to understand is exactly net indirect taxes. So what are net indirect taxes? This is nothing but a difference in between the market price, the taxes and the subsidies. So net indirect taxes is the difference in between taxes and subsidies. See, when we say taxes, taxes are levied upon many of the activities. This is this net indirect tax is also, it is used to make a difference in between the market price and the factor cost, as we have been saying, market price and factor cost. So this is the difference in between the two. But first let us see what is this net indirect tax in itself. So net indirect tax is a difference in between taxes and subsidies. Tax and subsidies. Let us define these two words. Taxes are levied by the government on different activities. Basically or mainly, the taxes are of two types. Direct taxes. Let me do one thing. Let me change the color in order to make you people understand in a better way. Direct tax and indirect tax. See, this direct tax is levied upon, levied means it is incorporated, it is asked from, or it is taken from, levied upon your personal income or your income. income. So you have an income, you are being asked to pay a tax. If it exceeds to a particular slab, this is called the direct tax. So in other words, the greatest example for it is income tax. We all pay it at some point of time. Okay. Indirect tax is levied upon the, say, producing units. Levied upon the producing units. We'll keep our terms a bit simple for some time being. So for that, an example is corporate tax, or for you people it will be, okay, GST. GST is a tax which we are paying nowadays. It is the latest form of your sales tax and all. So GST is an indirect tax. But in contrary to it, subsidies are being paid by the government to these producing units or to the individuals as well. So subsidies are something which are being given by the government for doing nothing, against which you do not have to provide any good or service. So here goods in direct and indirect taxes, goods and services get involved. Here subsidies are being paid by the government to the producing units or to the individuals against nothing. It is also it is technically called as a transfer payment. So subsidies are being provided by the government. A small example for it will be, say, khadi and village samitis, the khadi cloth in India. Khadi cloth is something traditional, something very national in its nature. So if a producer is making producing khadi for, say, 300 rupees per meter, but an individual, a consumer, gets it for, say, 200 rupees per meter, who is paying this 100 rupees is basically the subsidy given by the government. It's paying by the government. A gas cylinder for which we pay 840 rupees, okay, for a gas cylinder we pay 840 rupees. If we have to pay it with the subsidy, we will have to pay 1000 rupees. So the difference between 160 rupees, this is being paid by the government. This is a relaxation by the government. So the third term which we were talking about is NFIA. NFIA is the net factor income from abroad. Net factor income abroad is a difference in between the factor incomes earned. I'll write it down in order to make you people understand properly. So we are now talking about NFIA, the full form for which is net factor income earned, not earned, I'll do it later, net factor income from abroad. See, you have many people who are working in your nation, and you have many people who are working outside the nation. So these people earn something, but there is a difference in between the two earnings. It is from abroad or to abroad thing. When we say net factor income from abroad, that means whatsoever is earned by our people from outside the nation. And when we say the net factor income from to abroad, means whatsoever is being paid to the outsiders. So there is a very small and simple formula for it. So net factor income from abroad is equal to net compensation of employees plus net income from property and entrepreneurship plus net retained earnings of resident companies abroad. So we will use all these very things together, but for a time being you have to keep a very small thing in mind, that NFIA, that is net factor income from abroad, is factor income. I'll write it on top of the screen here. That is factor income earned from abroad. Abroad means outside the nation, by residents. Okay, in factor income earned from abroad by residents subtracted by minus factor income of non-residents in domestic territory. So that is what I was explaining also. So keep this very thing what I am putting in circle in mind for a time being, then we will come upon this all very concept, how it is equal to net compensation of employees, what is net compensation of employees, net income from property and entrepreneurship, and earnings of resident companies abroad. We'll come upon it later. For a time being we are now able to understand this very thing very properly, that what an FIA is. For we people, this is very important here to understand that what we are talking about. What we are talking about is the aggregates of national income, and when we talk of aggregates of national income, we were talking about 8 aggregates, and we were able to understand how we can reach from one to another. So if we now talk about aggregates again, if we talk about the market price, so market price will be equal to, I'll take one, rest you may be able to demonstrate or practice at home. See, I'll take market price. Market price. If you are being asked what is market price equal to, so market price, it is the ultimate price we paid by an consumer or an individual in the market. So will be equal to factor income. So the factor incomes plus the indirect taxes. I'll make an example for it. Indirect tax minus subsidies, and you all know what are factor incomes now. By at this very moment you are well aware about the factor incomes. I'll demonstrate an example for it. Say Mr. X went to the market to buy a pen. He bought this pen for rupees 150. From the shopkeeper for 150 rupees. The shopkeeper had bought it from the producing unit. Say for the shopkeeper had bought this very pen, say for rupees 120. For this 120, some tax is levied, say GST is levied. Let us say you have 15 rupees as GST. This comes equal to 135. There is a difference of 15 rupees still. So in this case, let us make this more lucid. Say this shopkeeper had bought it for 140 rupees. 10 rupees are levied as tax, so you are paying the summation of the two, 150 rupees. Now let us make one more example. Say in order to produce a gas cylinder, okay, in order to produce a gas cylinder, you put some labor in it, rent for land, you have put some in capital also, and you have some managers and organizers, etc. This all takes 800 rupees. So we will make it some more in order to incorporate. Okay, this all becomes equal to 1000 rupees, 1000, but we get it for 850 rupees. The rest 150 rupees are being paid by the government, given to we people as subsidy. So you have to keep both the two things in mind, taxes as well as subsidies, when you talk of the market price. Likewise, factor cost is equal to market price minus indirect taxes. Gross domestic product at factor cost will be equal to GDP at MP and less of indirect taxes. So we now will be able to perform some basic calculations or basic activities, or we may be able to understand it really very properly. Before we do certain numericals and all, let us make a structure in order to make you people